Welcome to the final part. So, the full series is in the playlist below if you are just joining here. So, we've got Neil Blankstone, Senior Investment Manager at First Equity, which has been active in London's smaller company market since 1987. So, Neil will be joining Richard Angus and Doug Lawson for a panel discussion. In the discussion, they cover the structural challenges facing UK private and public markets, capital moving to the US. We've also got the new PISCES framework, the FCA revised high net worth threshold, and the tension between a government that says it wants more investment and a regulatory environment that doesn't always support it. So they address the question that matters most to founders and investors right now. In this environment, what actually makes someone commit? So let's get into the panel.
I'm Neil Blankstone. I'm Senior Investment Manager at First Equity Limited. We were actually the first interdealer broker in London in 1987 and have evolved so that I sit across both private company activity and public markets, particularly UK AIM, working with retail investors as well as advising companies. I suppose what gives us a slightly different perspective on valuation is because in public markets, pricing is continuous and constantly tested, whereas, of course, in private markets, it's more episodic. So I tend to focus on how a valuation translates into something you could actually execute in a transaction, not just what a model implies. And that's also relevant to where I'm a director of two other businesses, one sports related and one media related.
So I think what you're saying is that basically people have got to get a touch of reality rather than the theory when it comes to looking at businesses. And one of the things we're finding is there's a lot more inquiries about private companies, about valuations, about strategy. Do you think from that perspective, the market's becoming more disciplined in the way they look at private companies, whereas in the past it might have been a little bit less obvious how companies were valued?
Yeah, I'd probably frame it slightly differently. For me, I don't think valuation is suddenly becoming more disciplined. I think private valuations are actually being brought back towards market reality, particularly after a period where capital was abundant and assumptions were certainly more optimistic. If you look at public markets, especially UK small caps and AIM, that repricing's already happened. So what we're seeing now is a convergence where private valuations are being tested more rigorously against public market comparables as well, actual transaction evidence, and also the real cash outcomes. So it's less a new discipline, I'd say, more a reconnection to executable pricing.
So when we've looked in the past, in where there's been more blue sky, shall we say, out there, people have looked at valuations of businesses over a period of time with a fair degree of confidence. What we're finding lately is that there's been a massive amount of focus on whether a company has any room risk, any cash, running out of money risk or not. Whereas other companies are finding it relatively easy to obtain money because they don't need a lot of cash, but they've got a great goal. Do you think the world is changing and there's just almost like two variations in the way investors will look at companies, two classes? Or do you think it's all still in
What
one
we're
bucket?
definitely seeing is a divide in how companies are raising capital. From a valuation perspective, that seems clear. The divide isn't just between strong and weak anymore. It's definitely between businesses that can justify their valuations with hard evidence and those relying on sort of narratives. I think investors today are definitely asking the questions what's the real comparables? What's actually traded? What's been your path to cash generation? That sort of thing. And in that environment, valuations are becoming much more evidence-based. So in a UK context where capital has been more constrained, obviously that process is actually more advanced, which is probably why markets publicly, like AIM, we're often seeing more realistic pricing earlier in the cycle.
Richard, do you mind if I come
No,
in
of course
here
not.
with a question? I was just wondering, to what extent you think it's overdone with AIM? Some of the valuations I look at now are, if you were to look at private market comparisons, they're, a material discount. And it makes me wonder whether this whole de-equitization story is putting pressure on those valuations. So the fundamentals, it's not so much an issue with the fundamentals. it's the fact that nobody wants to own UK small cap equities or AIM equities, and
I don't think
the
it's a
impact
case
on
of
valuations.
I don't think it's a case of nobody wants to own them, Doug. I think it's just a case that the pull to the US has been so great.
Yeah.
I think regulatory consequences have had a significant impact on this. Obviously, what we're seeing now is a bit of a conundrum in some ways, with government signalling they want people to invest more. Obviously, the London Stock Exchange has suddenly realised to a large extent that, hang on a sec, we need to get a bit back, so that they've nosied their way in, I will put it, and I've told them this directly, so I'm not saying anything out of turn here, into the private market ecosystem, which actually in the UK works really, really well. If you think of, many of the players that there are around, Republic Europe, loads of the venture capital and other funds that are investing privately and very successfully, that are backed by angel investors and others. So it's just an environment where the London Stock Exchange has obviously now implemented PISCES with government support as well. There's a bit of a game being played because they're giving with one hand, yet of course they're, the government at the moment seemingly has or is attacking wealth, probably. I think it's reasonable to say, with a real push to try and balance up income as against wealth and capital. So we're going through a process in the UK to reinvigorate our UK capital markets. We have fantastic people here with real skills. The problem is they're being almost deployed elsewhere. The attractions for companies is listing valuations are so much higher in the States. Why list in the UK? What we know is there's a buildup of enormous amounts of cash, particularly in the pension fund world, to fulfill the agenda of whichever government is in power, deploying that back into UK through infrastructure, tech, digital, and so on and so forth has to be the aim. So they're trying to make the headlines about the environment being more friendly. Actually, for retail investors, interestingly, and private investors, of course, the incentives are all there. And Richard sits on the EISA, which obviously is significant. But then we get the FCA creating a two-tier situation, coming up with an arbitrary figure of £10 million as a cut-off point for high net worth and ultra high net worth. So we're getting a lot of mixed messages. And what we know is people are ready and good to go. What we're finding in terms of the valuation and the questions being asked of businesses is, okay, where are you in the journey? Because cash is king, undoubtedly. It's the strength. I think the other side is, with what happened in the Middle East, that put a lot on hold as people then reassessed. We're still unsure how that's actually ultimately going to play out. So we're in that sort of where to from here. So people are going to be more selective.
Thank you.
So I think, talking to a number of companies, they have found private companies raising money, maybe using EIS or whatever, recently relatively hard. And yet we think there is money in the background, and we have fantastic entrepreneurs in this country with potentially great businesses. What do you think are the key factors that are influencing investor confidence? And importantly, the thing that makes them press the button and make a decision about investing, as opposed to saying, very interesting, thanks very much, and they go away for the time being. Whereas in a bull market, if you didn't invest, you would basically, the fear of missing out would be your primary thought, and you think, well, I better do something. So how do you feel about that whole topic about making decisions?
Yeah, I think, again, you have to look at this as to two very different mindsets. In America, as against what the UK. The UK's model has been all about de-risking. So therefore, ultimately, it's going to come down to confidence and something that's defensibility. If you can explain the valuation clearly, ultimately, with credible comparisons, realistic assumptions, and aligning yourself actually with the actual market transactions, the biggest shift we're seeing is investors are moving away from accepting a single point valuation, instead probably wanting to understand better the range, the sensitivity, and the downside case. At the end of the day, a valuation only really matters if it can be converted into capital or a transaction. And ultimately, any investor going in wants to know how realistic is what I'm going to get out.
So when we've got companies that provide, or when you have a company provides you with a business forecast based on a desktop valuation, a DCF valuation, you've also got, and Doug knows a lot more about this than we do, but there are real transactions taking place which are endorsing what's actually happening. How much do people look at the future and the theoretical valuation on a business and the quality of the management, as opposed to say, no, this is where we are now, and they're actually looking at the facts in the marketplace when they make a decision?
At the end of the day, I think private markets are becoming more institutional in their valuation approach. So from a valuation perspective, I suppose I'd describe it as a shift from model-led to market-led thinking. So where historically private valuations relied heavily on internal models and funding round benchmarks, what we're seeing now is much greater emphasis on external comparables, transaction data, and independent validation. So partly the structural maturity, but it's also a function of the environment. And when capital is less abundant, which because of the uncertainties, certainly at the moment it is, naturally investors demand the valuations stand up to real world scrutiny.
So in a sense, the buyers, if you like, the investors are sort of in control, whereas in a bull market, you could say the companies are more in control in terms of valuation.
Yeah, it's definitely a buyer's market at the end of the day, because there's also, going back to Doug's previous point on AIM and valuations, there's huge alternatives on discounted valuations that sort of just don't make sense. So it's then about an assessment of risk. And what we've not got at the moment is a trickle down in the UK, for example, from mega cap and 250 down into the UK smaller and then private markets as much.
Yeah. Well, look, Neil, that was fascinating. Thank you very much for joining us. Unfortunately, we've run out of time. We've raised a number of points, which I think we're going to have to discuss in the future, but it was great to get your thoughts.
So Doug's point about the shift from model-led to market-led valuation thinking is definitely a good one for us to end on. When capital is tighter and scrutiny is higher, valuations have to be grounded in what the market will actually bear. That's a discipline, but it's also more of an honest basis for a deal. So that's the end of the Hardman Co Private Company Valuation Forum. Thanks again to Doug Lawson at MarktoMarket and Neil Blankstone at First Equity and Richard at Hardman. You guys have been great. A reminder to everyone, though, everything discussed across this series is for informational purposes only and does not constitute investment advice. So if you found this useful, please do subscribe. And if you have topics you'd like to see covered in the next forum, please leave them in the comments below. We'll be waiting to hear from you. Thank you.